And the most recent development there is that the expenses that are paid with those funds are deductible for federal purposes, but not for Minnesota income tax purposes right now. So if you have a business, if you got a PPP loan, just make sure you're current on what those rules are, and your CPA should be able to help you. Now we have stimulus round 2. There's a second round of PPP, which is a little bit different. Basically, you had to have a 25% drop in revenue in any quarter compared to a quarter in 2019. There were stimulus checks sent, $1,200 for married couples, $600 for single people, and $600 per kid under 17. That is based on your 2019 AGI being 75,000 or under if you're single, and 150,000 if you file a joint return. That being said, if you didn't meet that criteria for 2019, but you will in 2020, you can still get those credits on your 2020 tax return. So again, something to be aware of if your income fluctuates year by year. And then in a shout out to our restaurant friends who had a tough 2020, meals are normally 50% deductible. They will be 100% deductible. This is if you have a business when you have meals at restaurants in 2021 and 2022. I think the biggest, so that's the stimulus. Coming out of COVID, it's become pretty clear that you need to be prepared for pretty much anything. And not only that you are, but that your parents are too. A lot of us are of an age where, you know, our parents are in their, say, 70s and 80s. And if they don't have their act together, I can assure you it will become your problem. So some of the things I'm going to touch on is things I've learned from being my client's CFO, personal CFO, and how you can do better. So let's see what kind of, my next section, I'm going to go to one of the biggest areas where you should make sure you're prepared and your parents is estate planning. And I know someone had asked those questions, so I'll go there. Does anyone have any questions about the COVID stuff I talked about? Want to go deeper in any of that? All right.
Checking the chat, so I'll let you know.
I'm watching the chat too.
Cool.
Okay, so what do I mean about being prepared? So I mean general organization of your finances, and I'll get into that, but also estate planning. So let's see, how soon should you start estate planning? So the youngest age where it becomes relevant, if you have kids, when they turn 18, you have no legal right over them. I have a kid who's 18, it's a little frightening, but you couldn't manage their finances without a power of attorney in place. And if heaven forbid something happened to them with their health, you couldn't make healthcare decisions without a healthcare directive in place. So in fact, I wrote an article about it on my blog if you want to look there, but you know, it's kind of a list of things that I did with my son before he left for college. And those are the two big things. The third thing for 18-year-olds would be a digital assets authorization. So if you do not have specific language that someone, a named person, can deal with your digital accounts, LinkedIn, Facebook, that kind of thing. I'm sure you've heard horror stories of people who couldn't shut down the accounts of people who passed away. So you need to have something like that in place as well. Because a power of attorney and that kind of thing doesn't work after someone passes away. Sorry, I'm going to back up. I see a question from Susan. If you didn't get your taxes in until 2019 tax return filed and you made less than 75,000 in 2019. Yeah, so basically if you didn't get your 2019 tax return done in time to get the checks automatically, then when you file your 2020 tax return, you will apply for a $600 credit on your 2020 tax return. So make sure you talk to your CPA about that. Or if you use TurboTax, again, there should be a pretty robust questioning around that. Angie asked, what did I call that document? It's a digital assets authorization. I think if you Googled it, you could probably find it. I also have a one-pager I could share with Anne. I see Anne referenced my article about college students. I mentioned TurboTax and Ellen asked about it. So accountants are expensive. Are services like TurboTax really legit? So here's the deal with TurboTax. It asks you a million questions. And as a CPA, I know how to answer those questions to get the tax return to do the right thing. You know, if you have a W-2 and, you know, a house and some mortgage interests, a relatively basic situation, I would say TurboTax is fine. With this $600 credit, and if you have a business, if you have any level of complexity, I would tell you that a CPA is absolutely worth it. You should be able to find a good CPA that, you know, can do your tax return for, you know, a few $100s. And if you need any ideas on recommendations, I can help with that. So I'll continue on estate planning. So you should have a will or a trust. You for sure should have a will if you have kids, because your will is where you name your guardian, I guess, of your kids if something happened to you. So that's usually what kicks people into high gear on doing a will. I won't get too far into the details, but there's you also can have what's called a revocable trust, which is kind of like a will, but it's just a different way of saying what's going to happen to your assets. And then you title all of your assets into your revocable trust. So you have an attorney write a revocable trust for you, and then you change the title of your, say, investment accounts to the name, so the Angela Alvig Revocable Trust. What a revocable trust does is, I think in Minnesota it's 75,000, maybe 90,000. If you have assets in your name above that amount, you have to file probate. If all of your assets are in your revocable trust, your trustee can just handle it without having to deal with the courts and probate. Probate isn't a terribly difficult thing to deal with in Minnesota, but it is public, so people have different opinions about that. To get everything retitled into your revocable trust is more work, but what I tell people is you either do that work now or you do it later. So I've had this conversation, I'll give you an example. I've had this conversation with my own parents. They are not even sure they have a will. So if you don't have a will, your assets would just follow state law, which is your spouse if you're married, and then your kids if you have kids, which my parents are generally fine with. But if they had a trust and they went through the activity of doing that, then I could do all the work ahead of time now when I can make my own time to get assets titled into their revocable trust and know what's going on. Versus if they pass away, I got to deal with the court and things, and that's perhaps a big inconvenience for me. So that's my push with my father. Do you really want to inconvenience your lovely daughter, or do you want me to let me do it on my timetable? So I guess I'm assuming that I would be in charge of my parents' finances and not my brother's. Anyway, and then the last thing you should make sure about for estate planning purposes is some of your assets would not pass by direction in your will. They are based on whom you name as your beneficiaries on your accounts. And that would be life insurance, your 401k, 403bs, and your IRAs. So you should, if you do nothing else from what I've told you, you should check your beneficiaries, particularly if you've had a change in your life, like such as got divorced or something like that. I wrote an article on this as well. There have been horror stories of people's entire retirement account, Allison's nodding her head, going to their ex-spouse, which is not good. So make sure you check those. Let's see, any questions on estate planning, what I've covered so far? Oh, Anne pointed out that St. Ben's alumni have access to free will where you can create your own will for free. That's great. I'm looking at other questions here.
I'll also put the link to Angela's full blog into the chat here in a minute, so everybody can see that.
Okay, Steve, I see your hard questions about political landscape and investing strategies. I'll touch on that later. And then multiple retirement accounts and combining. So I will, and Patrick asked too about taking a 401k from a former employer. So remind me about those, Anne. Let me see if we got any new questions here. Okay. All right, so let's talk about doing a financial inventory. So I always tell people they should know 4 key things: what you own, what you owe, what you earn, and what you spend. So my recommendation, and again, I would say you should do this, and so should your parents, is create a personal financial statement, make an inventory of everything. I always tell people the amounts of your accounts is actually the least interesting thing on that inventory, where they're located, account numbers, things like that. So that if somebody had to act for you, whether, let's say you're married and you handle all the finances and your spouse, you've just delegated that among one of you, your spouse or partner, you need to write it all down so that somebody, the other person knows. Same thing with your parents, right? In my example, if I'm my parents' personal representative and I don't even know where their bank account is, I've got a real problem. That becomes, it's one thing if people get everything on paper and you can dig through a drawer and find things, but when everything's online, that is a problem if you don't inventory it. So in addition to that, you should be collecting your passwords. I recommend using a password manager where, number one, you're storing your passwords electronically. As they change, you can have harder passwords and not the same password for everything. And you can share them with your spouse or partner, with your parents, everything through whatever app you may choose. If you own a business, it's important you get and stay organized. I typically use QuickBooks. I just recommend, it's easier to start right when you start your business. I don't recommend collecting a year of receipts and then dealing with it later. I do recommend that you have a team of professional advisors, again, particularly if your life is a little more complicated. You own a business, you have more financial accounts, your CPA, your attorney, your financial planner, but also other things like, a life insurance person, a banker. And I always tell people to ask questions. If you have those professional advisors, ask questions of them until you understand. My experience is that the people who profess to know the least about finances actually ask the very best questions. So, sometimes people worry about asking stupid questions, but, in my whole career, that's kind of how I've learned what I know, by just asking, because, we all went to St. Ben's and St. John's. We're smart. So if we have a question, somebody else definitely does. So that is my spiel on why you should make a financial inventory and know what's going on. Let's see here. How can philanthropy and estate plan work? So, hold on, my computer's talking to me. Okay, so yes, there are tax advantages to philanthropy. It matters more in your estate. Well, I'll say a couple things. So I mentioned beneficiary designations on your IRA. Your IRA, when you take money out and or leave it to your heirs, comes with a tax bill attached to it if you have a traditional IRA, not a Roth IRA. So your IRA, if you for some reason don't need it for retirement, or you don't have children, or you don't have other people you would name as beneficiary of your IRA, you can name a charity, St. Ben's, St. John's. And what that would do is it would, it's a good asset to leave to charity, because the charity doesn't have to worry about those income tax implications I mentioned, but your heirs would. So some of my clients who, believe it or not, their IRA is not something they'll ever need, they do that a lot. As far as putting a charity in your estate plan for estate taxes, right now, at the Minnesota, the level for a taxable estate is $3 million. So if you have more than that, then you need to worry about that and wanting to save estate taxes. If you're transferring it to your spouse, you don't pay estate taxes on the first death, but anyway, I won't get into that. But depending on how much you are worth, your net worth, that you can determine whether estate taxes matter to you or not. But you can save income taxes and estate taxes with charitable strategies. Okay, so let's talk about things I wanted to touch on accounts and things that most everyone should have and how to use them. So let's touch on your employer retirement plan, your 401k, 403b. So, I'm sure we all know, make sure you're contributing enough to get the employer match. That's just free money. I don't know that we have a lot of new grads on the phone or on the Zoom call, but start maxing as much as you can, as soon as you can, because if you get used to not having the money in your budget, it's easier to start out low and versus trying to, increase your contributions later, and then it feels like a pay cut. As far as so someone asked about what do you do with your 401k from a former employer? So you can leave it there if you would like, or you can roll it into an IRA, rollover IRA with, whatever financial institution that you want to. Look at the costs and the fees inside your 401k and whether those are less than rolling your IRA out of your 401k and having an investment advisor manage it. But if you have your IRA outside an employer plan, you may, in combination with your other assets, reach a threshold to be able to, work with a wealth manager. A lot of them have minimums. You have to have $500,000 or $1 million to work with them. That would get you over that threshold. So there's all kinds of different things to think about. Let me see. Did that touch on the questions that were asked about?
And Angela,
IRAs?
somebody asked about jumpstarting or boosting a retirement plan to, quote, catch up.
Yeah. So when you turn 50, there is by law catch-up contributions. When you're 50 or older, it's like $5,000 or $6,000 more per year. This is why I advise people to max out. I mean, 19,500 or whatever it is for 2021 is a lot for someone starting out, but it's harder to catch up than it is to maximize what you can right out of the gate. So that's my 2 cents on that.
And Angela,
yes.
You mentioned rolling over your 401k or 403b. I think we should probably also note that you should never just pull it out to move it into your account and then move it again because you get taxed.
Correct.
Right?
Yeah. If you're doing a rollover, you want to get set up with your new institution and then they talk to it goes directly from the 401k to, you don't touch it. The check doesn't come to you. I also want to touch on a lot of employers now have a Roth 401k option. Whether or not you should do, Steve, to get into your maybe tax/investing question, the question on whether or not to do a regular 401k or IRA or a Roth 401k really depends on, do you think your tax rate is higher now or will be higher when you retire and have to take the money out? Nobody really likes to give up the tax deduction they're getting by contributing to their traditional 401k. I would encourage that you maybe at least split the difference and put 50% to the traditional 401k/403b and 50% to Roth. But there is benefits. You'll be glad when you retire that you have a tax-free bucket, which would be your Roth IRA. So the biggest thing is to try to create different buckets of tax profile. So you got your regular 401k or IRA that is taxed when you take it out. You got your Roth IRA that would not be taxable when you take it out. And then your excess savings that would be invested in stocks, etc. If you sell those, you have capital gains, but capital gains have a lower tax rate than ordinary income, which is your Roth IRA, your IRA or 401k distributions are taxed at ordinary tax rates, which are higher than capital gain tax rates.
How about having multiple retirement accounts, Angela? Do you leave them where they are or combine them?
I mean, I value simplicity, hence my company name, Simplify Wealth. So people often think that by, I have clients who sell their business for millions of dollars, right? They do they typically do put their money with a few institutions for a few reasons. Number one, you don't necessarily know how they're going to do related to the market. So you want to have a few different advisors that are working with you and you monitor how that's going. They also feel that that's diversification. I'm not saying it isn't, but here's when it's not. Let's just say each of those 3 wealth managers are buying the exact same stocks. That's not diversification, obviously. So if you have separate accounts, you need to be monitoring them on a global basis, you or somebody, to know your overall asset allocation to equities, US equities, international, fixed income, blah, blah, blah. If that makes sense. So it's less about who it's invested with and like who's managing it for you and what versus what it's invested in. Let's see. What might you advise regarding investing a pension versus leaving it in the company account? I mean, in general, it's what's the lump sum? How would you invest it? What do you think you can earn versus the pension company and what it might earn? Taking, and it's, I guess it just depends on how you feel about taking more control over that asset versus leaving it in the fund and what kind of company it's in and are they going to be around and that whole thing, right? Because there have not all the time, but some pensions that are underfunded. So you might want to get the financial statements or some kind of information about that pension plan and how it's doing financially. Let's see. In investment accounts, taxable, what key things to look for, what gives most weight, higher fees, blah, blah, blah. So Allison, this is your question. Do you want to touch on kind of what you mean by that question?
Yeah, I'm both like taxable and retirement accounts. Sometimes I'm deciding which like funds to invest in, and some of them are lower fees but track an index, and then some of them are like, target this is your retirement at this time, but there's higher fees associated with it because it's managed actively. In kind of deciding where to invest your money, what should you be looking for in those, and is the managed account but higher fees worth it? Or I've also heard things like, keep your fees as low as possible. So I know there's a balance there, but I don't know what's the right one.
Well, I mean, even my clients who have, millions and they are working with a wealth manager, typically I'll call it passive strategies like index funds are used, a lot of times with US equities and things where there's not a lot of alpha, which is return over the index that you can get from that. So having the lower fees and the more passive strategy may make sense. When you get into more sophisticated asset classes, things like that, there's also things like, the alternative hedge fund type investments that are non-correlated to the market. The returns are non-correlated. So those may be worth spending more fees on. So it just depends. Again, this is why my personal opinion, again, maybe it's because I'm not a investment manager. So it's the thing I am the least comfortable with. I think it's important to have a partner in that, a financial planner, a wealth manager. A lot of people like to do it themselves and put it in an index fund. And I've seen a lot of people be successful at that. So I'm not saying it's wrong. But I prefer the partner, or orientation, or like I did that for myself because my husband thought, well, I can do it. And I'm like, no, I don't think that's a good like marital strategy. So anyway, it's based in fact on how you pick this kind of thing, but it's also in some ways based on people's opinions.
We also have a question about what age would you suggest rolling your 401k into a Roth 401k?
So it's not rolling, it's changing your contributions. So let's just say you're 30, 35, and you've been making traditional IRA contributions your whole career. I would recommend you switch your contributions, your elective contribution, to be Roth right now, because then you're building this, tax-free bucket because you already got a, taxable bucket. So then over time you'll get to say 50-50. So I don't think Layla meant rolling. I think she meant contributing. You can't roll your 401k anywhere until you no longer work for that employer. Okay, since we're talking about investing, I'm going to read Steve Krebsbach's question again.
How do you, if at all, adjust your investing strategies based on the change in the political landscape?
So, I mean, generally, this is based on where people think tax rates are going to go. That's usually the biggest factor. So let's just theoretically say that capital gains rates may go up, right? Or corporate tax rates may go up. You would adjust based on that. So, so let's just say capital gains rates. Right now it's 20%. I'm sorry, I can't do it right. 20%. Actually 23.8 when you tack on the Medicare tax. Anyway, that's a lot lower than ordinary income. If capital gain rates went up, that would change how you might invest your taxable accounts. You know, same thing with that Roth versus traditional contribution I talked about. If we think tax rates are going up, you know, in the next 4 years or 40 years, then you should be making Roth IRA contributions. People may also choose to convert their entire traditional 401k or IRA to Roth. You have to pay the tax on that now, which is painful. But particularly if you're in the camp of not going to need that money, again, you'll be glad you pay the tax when the value is lower versus, you know, 30 years from now when if you leave it alone and it's not a Roth account. So those are just some things to think about, but I see when people are talking about the political landscape, it's all around where you think tax rates are going to go and how that impacts it, which then goes back to having a good CPA and having a good wealth manager and having these conversations with them as it relates to your specific fact pattern does have value.
Going back to, sorry, Angela, going back to estate planning, Kevin was asking about how to estate plan for individuals that are 3 to 5 years from retirement.
So, I mean, I don't really think the objectives of your estate plan really changes no matter how old you are or how close you are to retirement. It's more about where you want your assets to go and that you want it to go smoothly and name, you know, who's in charge, who's your personal representative, that kind of thing. You know, if you're married, that's maybe less of a concern because it's pretty obvious where that would go and who would be the personal representative. But, you know, unexpected things happen. I guess that's all I would say. So it really, and when you do your estate plan, it's also a good idea to revisit it with your attorney every 5 years. You know, a lot of people do it, set it up when their kids are born, and they do not revisit it for 20 years or ever. Or they don't do it at all. So, you know, again, I know it's expensive, but I've seen stuff get really messed up because people didn't want to spend a few $1,000s, and it costs way more than that if you don't do it. I've had to be named personal representative and trustee when family things went sideways and I had to do it instead of their kids, and it costs a lot more to deal with a mess on the back end. So that's my little soapbox about that. You have to spend money to make money, if you will. You know, you have to spend some money to not have a mess on your hands. And again, I have this issue with my own father. Good luck getting your parents to, you know, pony up the dough to do that, but it is worth it. But Anne, you pointed out the free will thing. So that's a really great start. And I'll mention that the power of attorney in the healthcare directive for your kids, say, who are 18 or older, or for yourself, if you just Google Minnesota power of attorney or Minnesota healthcare directive, you can find those forms. So you don't necessarily, those two forms and digital assets authorization are things, if you want to start somewhere, do that. And you can do it yourself and it won't be a disaster.
On the note of 401ks, if you have your 401k contributions covered as well as 6 months worth of your expenses saved and you want to invest additional funding, where would you recommend investing?
Okay. Yeah, so actually, good job, Evan. My next point is about Roth IRAs. So not Roth 401k, but Roth IRAs are vastly underutilized. In fact, I mean, you should be setting aside your 6 months worth of expenses. Good job, Evan. But you can only contribute to a Roth IRA if your income is below 140,000 if you're single and 208,000 if you're married. Now that may seem like, oh, that's kind of a lot of money. I'd love to make that. Well, you can get over that pretty quick. Basically, by the time you feel like you can afford to do a Roth, your income is too high to do it. So one thing I'll mention about a Roth IRA that a lot of people don't know is you can always take out what you put into a Roth without penalty, just your contributions. So if that may make you feel better knowing that, because in some way you can put money in a Roth and know that if you had an emergency, you could use it for that. So you can simultaneously cover your 6 months of emergency expenses and also start your Roth IRA. You can even keep that Roth IRA invested in a money market fund or something if you want to. And then when you feel like you don't need it anymore, put it in the market. But the key is getting it in the category of Roth IRA. And you can only do that to the tune of $6,000 a year, $7,000 if you're 50 and older, and if your income is below certain levels. So like I said, if you meet those, you should be doing it because that's really, really valuable. Let's see what else, other questions what I have, or other answers what I have to Evan's questions. And then we talked about, so then if you have your 401k contributions covered, you have 6 months worth of expenses in cash, and then you want to start investing. I mentioned the Roth IRA, but this is where if you want to do baby steps in, you can open a Charles Schwab account on your own and invest in an index fund or something like that. There's some investing you can start on your own if you feel comfortable with it. If you're not ready to hire a financial. Okay. Other accounts that you may have are health savings accounts through your employer. If you have a high deductible insurance plan. Couple things about that. A lot of times people put money into their HSA and then they just take it out for their current spending. There's not necessarily anything wrong with that. You're making your medical expenses deductible. But I would encourage you to think about, if you have the money to just fund your medical expenses now, to just let your HSA accumulate to use for healthcare in your retirement. Again, if you use it for medical expenses, it's tax-free. So it's like an IRA that's earmarked for medical and you won't have a tax impact. In the category of emergency savings, let's just say you just were using your regular cash flow to pay medical expenses, but then something big happened. You can, and then let's say your HSA is $20,000. Over 4 years, you put $5,000 in. And in year 4, you have $20,000 of medical expenses. You can accumulate over time how much in year 4, you have a need for cash, even for something else that's not medical. But over the past 4 years, you have paid out of pocket $20,000 in medical expenses. You can accumulate that number. Basically, when you take money out of your HSA, you just have to prove you spent it on medical expenses. And it doesn't even necessarily have to be in the current year. You can be reimbursing yourself for medical expenses you had a few years ago if you need the money. So again, it's another way you can say, okay, I'm going to leave this for the long term. But then if something unexpected happens, you can also tap into it for call it emergency needs. Let's see. Eric said, if my income and tax rate is greater today than it will be in retirement, how do I make a Roth contribution make sense? Yeah, no, I totally get it. We could debate this for hours. Some people say tax rates are absolutely going up. There's no, based on, again, the whole thing about Social Security underfunded and the national debt, and then we're not even going to get into that. But it's a assumption you got to make, Eric, on what you think. And a lot of people think what you think. They think that when they retire, their income will be a lot lower. But if you have, particularly people who have a pension, like my in-laws, my father-in-law was a teacher, he's making way more money now than he was. Now, a lot of us don't have a pension, so that's different. but people are typically surprised that their retirement tax rate is not lower. But again, it's something to debate.
Angela, can we talk a little bit about how to know if you're financially ready for a big purchase, like a house and car, for folks that have not done that yet?
Sure. How to know? So let's see, let's start with a car. So, well, I'll use a real life example. So I have a client, and her son, he got a job, really good job. And like the first thing he did was go out and lease a, car with like a $500 a month car payment. Even though his brother was like, why don't you just go buy a used Lexus that's super safe and it's, I don't know how much money, $15,000 or $20,000 versus, this brand new thing, right? So I think it depends on it. As far as the car situation, it's like you got to make a wise decision based on where you're at, because everybody needs a car. I'm a big proponent of buying used cars. Anyway, I won't get into all that. Leasing can make sense. If you have a business, you can deduct the whole lease payment, so there's just a lot of things to think about when you're buying a car. But in general, don't buy more car than you need for where you're at in life. For a house, look at what you qualify for. Talk to a good mortgage person. It's typically, I think, 3 times your income is the mortgage you can qualify for. It may not be the mortgage you want, depending on what you want for your life. You can get mortgages that involve you putting less than 20% down, or you can get mortgage insurance. You're required to have mortgage insurance if you put less than 20% down. So I'm not saying like you shouldn't buy a house unless you can put 20% down. But if you have 20% to put down, that you're definitely ready to buy a house. I'll put it that way, right? Sometimes people get gifts from parents or things like that to buy a house. But again, that's for having a good mortgage advisor, not someone who's just going to, coupled with maybe your financial advisor or yourself, if you're educated on these things. Don't necessarily just get the biggest mortgage you can afford, depending on if you are married or have a partner, if you want to be living based on 2 incomes. I think we've seen that recently this year that can change. Again, it's personal preference. I mean, some of my really wealthy clients live on a lot of risk and they're okay with it, right? So, but they have a little more to fall back on. It's kind of like the tax rate now or in retirement. It depends. But I will say, if you have, if you've got 20% cash to put down because you've been saving, I think you're okay. And mortgage rates are super low right now. However, house prices are also really high. So, that's complicated. 529 college savings plans are, a good idea. When it's used for college expenses, it's tax-free. Or, tax-free growth. It's kind of something you can set up even if you're doing, $25 a month when you start out. I actually make contributions to all my nieces and nephews' college fund, which they don't appreciate opening a really boring $10 gift from me on Christmas, but their parents appreciate the contribution I make to their 529 plan. So don't even get me started on Christmas and how ridiculous I think all the over gift giving is. But anyway, it's something that you could also set up and ask, ask parents or, other people can contribute to the 529 plan. People worry about overfunding their 529 plan, but you can change who it's for. So, if you don't use it, you can change it to be your grandkids and all that kind of stuff. So you can use it in that way as well. You can change the beneficiary on the 529 plan. Life insurance. Typically people start thinking about this when they have kids. Really all you need is term insurance. There are, I'll call it permanent policies that have cash value and stuff. It's not the first thing you need as you're starting out. Just get some term insurance, 20-year term. It's super cheap when you're young. And, permanent insurance becomes more important when if you have a business and you have a buy-sell agreement between you and a partner and you have to fund things. So, I'm not saying permanent life insurance doesn't have its place, but just, educate yourself a little bit on that. But term is I'd say a sure thing if you have people who count on you, would need to be taken care of if something happened to you. Paying off debt. So some people feel overwhelmed if they have debt. Where do you start? My recommendation is you pick your highest interest rate, credit card or loan, and tackle that one first versus paying off all of them a little bit. You're never going to get anywhere. Well, people always ask, should I pay off my mortgage? If they get to a point where they could pay off their mortgage, it depends, right? I mean, if your mortgage rate is 3%, now they're like 2.5%, I would say probably not, because you could probably earn more on, you would have to take that money out of investments or not put it into an investment to pay off your mortgage. Some people really, really want to do that, and I don't argue with them about it. Again, it's personal preference. If it makes you feel better to not have that mortgage payment, then more power to you, So there's a balance, I think, when you're dealing with making financial decisions and like, what's the numbers right answer. And you should definitely know what that is. You shouldn't make a decision without knowing that. But if you weigh that against emotional reasons, that's valid. I have clients all the time who make decisions that they know are not, the technical financial right answer, but it makes a difference emotionally or for their relationship or something like that. And that's important. We talked about building a cash reserve of 6 to 12 months as you can. And then just general budgeting tips. Like one of my clients, he has 3 homes and he's plenty wealthy, but it drives him bonkers that like one of his DirecTV bills is $300 a month and one is like $80. So I called, I asked for the best promotion they had, and I got them all of them down to, $125. So, make phone calls to some of your vendors. Calling DirecTV is like, I'd rather stick a pencil in my eye, but it can be worth it if you know what you're asking for.
Hey, Angela, speaking of properties, we have Shanta who is on with us from the Bahamas.
Oh, yeah.
She wanted to talk a little bit about timeshares.
Oh, boy, my favorite topic.
I'm not sure if I'm going to pronounce this right, so you can correct me. Are U.S. situs timeshare ownership with title deeds provided qualify for equity or to owners or not? She says maintenance and taxes are paid.
I don't really know. I'm not sure what she means. Can you have her email you her question and I'll answer it?
Shanta will put that in there for me into the chat, I'm sure.
Okay.
And she also asked about alternative savings.
And then tell her I'm coming to visit her.
Financial.
Yeah,
right.
I can make a personal visit to answer her question. Sorry, what were you going to say?
She also wanted to know about alternative savings without using a financial institution and what you think of that.
Oh, okay. And then I see somebody asked about Bitcoin. I think they asked if I have clients who invested in Bitcoin. What do I do with my mega Powerball winnings? Okay. So Bitcoin, first of all, do not lose your password, because I have a client who did. So again, this goes to I have clients who have Bitcoin, but I have one who he was investing in. I mean, I know it kind of has gone up quite a bit recently, but he was investing in it in early 2020 before COVID happened. He was selling out of it. So I don't know a ton about it. I'm not big on stuff I don't understand. And, so I'm not saying it's a bad thing. This goes into the debate about all kinds of different things. There's some people who say you should be in alternative currencies because of all these things that could happen. So again, educate yourself on it. It may not be a bad idea for you based on your situation, but don't lose your code. If you're the only person who knows your code and you kick the bucket, that's a problem. So that goes to my point about inventorying what you have.
We have a couple. Go ahead. I was just going to say we have a couple of people asking you what your ideal client looks like.
Oh, yeah. Okay. So I would say we have three common themes in clients we help. The really wealthy, complex ones who are investing in real estate and businesses, and they're like ideas people, and they have all these details that may or may not be chaotic. That's my job, to be their handler, if you will, their personal CFO, deal with all the details, close all their deals, pay the bills for their 3 homes, deal with their private jet. That's an extreme example. But even people who have a business and a busy personal life, they may want help with that kind of thing. Just managing all the details because they are growing their business or have sold their business and want to live their life, whatever. Then we have a lot of elderly clients, some that never had children, where they need us to watch over them, and their lives may be less complicated, but their needs are really great. So we help them. Sometimes I always joke that like my mother does not deserve like the eye roll I'm going to give her when she, asks me questions about helping her with her stuff. I'm going to send someone lovely on my team to like help my mom answer her questions about her bills. Cause she deserves to be treated with kindness. And so we're really endlessly patient with those clients on what they need from us, everything from healthcare things and financial, et cetera. And then we work with a lot of people going through life transitions, divorce, death of a spouse or a parent, or just life transitions with parents. We've cleaned out a lot of houses. We've helped a lot of people get their bearings when maybe they were not the one who handled the finances when they got divorced or a spouse passed away. We've helped a lot of those people. Sometimes they only need us for a while and we partner with them and then they can flourish on their own, or maybe they just need us quarterly. So we have a few different ways we can help. Some people hire us to do this inventory I've talked about because they don't want to do it because it takes a lot of time and effort, or to clear out their parents' house because they have 2 jobs and 3 kids and 2 dogs and, they don't want to deal with it, but they want to know it's taken care of.
I have clarity on Shanta's question. It looks like she's got, if we earn equity on home mortgages, does timeshare in Florida also attract equity from the owners? Attract equity that owners can draw from. So she owns a property in Florida.
So a timeshare, it sounds like. So
yeah.
So the problem with timeshares is not really. I have a client where her husband died. They had all these timeshares and she's got all these maintenance fees she's got to pay every year. And we can't even give it back right now. So I had one client where his parents could not afford their timeshare, and they were with Wyndham, and we were able to just give it back. Not buy it, not equity, just give it back so we didn't have to pay the fees anymore. So I'm not saying, Shanda, that your timeshare is worth nothing, that you couldn't sell it if it's a desirable one, but it's not as liquid as a house for sure, as far as the equity in a home. I don't want to be negative about timeshares. People, if you're using it and whatever you can afford it, that's fine. But when you turn around to sell it, not exactly. People are not super successful with that, but they could be.
Okay. Anne asked if she's a part of an LLC that was formed in 2020. There are no gains or losses. Does anything need to be covered in taxes?
So if you form an LLC, I guess there's a couple issues here. Number one, are you the sole owner or do you have partners? Because if it's a partnership, you may have a tax return filing. Now, if literally nothing's happened, no income, you may not have to file a partnership tax return. If it's a single member LLC and you haven't had income, then no, you wouldn't need to do anything. That would go on a Schedule C within your personal tax return. If it's an LLC that you solely own, that's called a single member LLC. Partners, she says. So again, I don't know what the file, you can find out what the filing requirement is for a Form 1065. I don't know if it's like $1 of income or more than that, but I have people who form partnerships, let's say to own a family cabin or something, and all there is expenses, not income. You could probably argue you don't have to file a partnership tax return. But if you filed for a tax ID and you're on the IRS's radar and you're just filing a blank one, it might be worth it, because there are, with partnerships, there are, I think it might be even $25 a day if you don't file some ridiculous penalty. So it might be easier to just file one, even if it's yourself. You file it yourself and it's blank, just to say you filed something.
So Angela, we're getting close to time here. I do want to get, there's a couple more questions about philanthropy in our little Q&A section here. How can philanthropy, i.e. putting CSB and or SJU in your estate plan, work into an estate plan? Are there tax advantages? And on top of that, Allison mentioned there is an above the line deduction. That. So just want to make sure you mentioned
because the standard deductions have gone up. So a lot of people with that and state taxes being limited to $10,000 of deduction, a lot of people don't itemize their deductions anymore. So that is valuable to know that you can deduct a contribution up to $300 to St. Ben's and St. John's, even if you don't itemize your deductions. And then the philanthropy thing, you know, there are reasons to work it into your estate plan. You know, basically your estate can go one of three places: to your family, to the IRS, or to charity. And those three buckets depend on your, you know, where they'll go, depends on how much you are worth and your values and all kinds of different things. I mean, I have some clients where they're leaving each kid a fixed amount of money and the rest is being left to charity. And their motivations for that have nothing to do with estate tax savings. It has more to do with not making their kids spoiled brats, their words, not mine. So definitely something you can consider. I mentioned the beneficiary designations on your IRAs too, is somewhere where you can name charities.
All right, I got one more for you. Last one. Evan asked, you mentioned paying down debt with higher interest rates. With student loan payments at 0%, would you recommend paying down student loans to aggressively pay them down if you have extra money, or allocate that extra money to other debt?
Well, no, if you've got 0% interest, I mean, you keep that debt all day long. Just keep an eye on if there's a threshold where it would jump. You know, I have a friend where she very aggressively managed her credit card balances for 0%, and then would go to the next card and the next card. She had a very detailed way to do that, and it worked for her because she didn't miss the deadline by one day where the interest rate went up to 20%, and then it all was due. So as long as you know what your rates are and that they're low and that they're fixed, or you know when they'll change, that's perfect.
Great.
Angela. Yeah, Angela, thanks for your time today. This has been a great session. It's been great to learn more about you and Simplify Wealth. And I think that the questions were obvious that there's so many different things we could talk about. And thanks for sharing all of your knowledge on a variety of these topics. We have one more of these series next Tuesday. Tim Mayer is going to be showing and highlighting hiring tips, and he's the director of talent acquisition at Kraus Anderson. So he's going to be talking about COVID and hiring trends during COVID. So if you haven't registered, please do so. This will also be a great session. And again, Angela, thanks for your time today. If you do have any questions for Angela, please feel free to reach out to her. Angela, if you're okay, Anna or I will share your email, and
Sure.
we're happy to put you in touch with Angela because she's a great resource. And even if she can't help you, she'll know somebody who can help you with any of your sorts of questions. So the last thing I'll say is that we did have a very successful referral day last week. So thanks to everyone who referred a potential student to St. Ben's or St. John's. If you are interested in donating to St. Ben's and St. John's for alumni scholarships, it's a great cause. And on the screen right now, you can see, well, that's actually our events, but we do at givecsb.com or givesju.com the links to make a donation to the alumni funds, which supports great scholarships for students. So thanks again for joining us today, and we hope to see you next week.